Hello, this is Brad Harvey with Harvey Investment Management, and this is our 2019 year-end update, as well as a 2020 forecast for themes that we think are going to be important to our clients and to all investors in the United States in particular. 2019 started out with a little bit of a rocky theme going on that started outside of the United States. A lot of foreign countries were trying very hard to reduce the value of their currency or the strength of their currency versus the US dollar. Why would they do this? Well, they want their stuff to be cheaper for people in the US that are buying. That's very good for their economies. So they wanted to lower the value of their currencies versus the dollar. Well, without being a currency manipulator, the fastest way to do that is to lower your interest rates even to go negative. And this was very broad-based in Europe in particular, where we saw those government bonds going to negative interest rates. That is a bit of an artificial condition, and so if they were bondholders in Europe and around the world that held those bonds going to negative interest rates, the net effect is they would have to pay to have somebody borrow their money. That doesn't really make a lot of sense. So what they did was they took their money and they bought US Treasuries. When this all started, the 10-year US Treasury interest rate was about 3.25%. And what happened was they started buying these treasuries en masse, and they bid those prices up, which means the yield goes down. In fact, the yield dropped rather precipitously in the first 6 months of 2019, and it went all the way down below 1.5%. So essentially, by them bidding up the US Treasury values and cutting those interest rates, it created an opportunity for US corporations to go out and refinance their existing debt. And they did this en masse. They actually refinanced their existing debt and went out and borrowed even more debt than they might need in the near term because it was so inexpensive. Well, this had the net effect of being pretty good for banks because banks are in the business of lending money. And banks make more money when they initiate the loans than they do to service the loans. So those corporations went out and refinanced their debt. After they pay those banks those service fees, that should hit their earnings in a positive way, starting in the fourth quarter of this year, which we're already seeing, and going into 2020. So that is a bit of a tailwind. Now, from an investment standpoint, from a stock standpoint, in 2019, well, we ended last year pretty much on a down note. The fourth quarter was pretty rough. It was pretty broad-based. We saw small, medium, and large companies get hit pretty hard. In 2019, those large companies recovered largely. In fact, from the highs of last year, the S&P 500 is now up almost 7%. Well, that's very good. The smaller and mid-sized company indexes really are fairly flat from the highs of last year, and non-US indexes, foreign large cap and foreign small cap, are actually negative. So what we see going into 2020 is actually a broadening out of this positive market performance. We're going to have tailwinds with the earnings getting better and better, we think, in the large cap side, and small and medium-sized companies should also benefit from that. Our economy fundamentally is strong. Our unemployment is very, very low. Our labor participation is getting better. And so that also has the net effect of people having more money in their pockets. Now, during all of this, since really 2016, we've had political issues that have been dominating the news cycle. This will push the market around a bit, and as we get into the election season of 2020, that's liable to get worse, not better. So stay focused on your goals and your investments and achieving those goals. This is Brad Harvey with Harvey Investment Management. We hope we have a great year in 2020.